Welcome to another developed video. Today, taking an in-depth look at AutoZone Incorporated, an American retailer of aftermarket automotive parts and accessories, the largest in the United States. We're going to look at the fiscal year 2024 for this video because it is full, so it has all 4 quarters reported. First, we'll start with the valuation. We can see a free cash flow yield of 3.51% and a price to earnings of 25.73, so a bit overvalued for the current market. Now going to business metrics, we can see a return on invested capital of 34%, which is very good. A return on tangible assets of 16%, which is also pretty good, and a current ratio of 0.84, which is okay. Their return on equity is minus 56% because they're a very good buyback company. So this company is known in the stock market for their buybacks. They're extremely well known amongst value investors because their buybacks have increased their share prices not insanely, but considerably. They've had a very great run, as you can see here. So their stock price has definitely benefited from all of these buybacks. Now let's go to Grant's valuation. I'm going to use the revised formula. The original formula doesn't really work anymore. Uh, with an estimated earnings per share for 2025 of $150, with a 6.5% projected growth rate and the current yield on AAA corporate bonds, we get an intrinsic value of $1,641 per share. Next, let's go to discounted cash flow. You can see that with a 6.5% growth rate, a 2% perpetual, and an 8% discount rate, we get an intrinsic value of $1,817. I like to stop a bit here the discounted cash flow and show you something. Uh, for the current price to make sense, they have to have a 15% growth rate. So the current DCF price per share is for a 15% growth rate. And also to add to that, I've used the 8% discount rate, and I usually use the 9% for my personal DCFs. And so this means that they're way overvalued from a DCF standpoint. And most people here invest only for the buybacks. So let's go back to 6.5%. Next, going on to historical multiples, we can see that their trailing 12 months PE is 25.32, whilst their 10-year average PE is 16.68. Their multiples valuation, so I've used 4 competitors: O'Reilly Automotive, Penske Automotive Group, CarMax, America's CarMart. They get an average PE of 27.66 multiplied by the earnings per share. We get an intrinsic value of $4,255. The dividend discount model doesn't apply since they don't give out a dividend. Output, we get the average of all of these three, which is the intrinsic value of $2,570. Of course, applying a 15% margin of safety, you get an intrinsic value of an acceptable buy price of $2,185. Now, what is my problem with AutoZone? Well, AutoZone is a great company from a managerial standpoint, since they've managed to have so many buybacks and increase their share price so much, and their revenue, their net income, everything. The problem with AutoZone is one of their future perspective. They will not grow anymore. So I've seen a few articles from value investors on Substack, and they pretty much attack the whole business model since the problem with it is that it's pretty low quality. And the thing is that customer reviews don't seem to matter for these corporations, but they don't matter until they actually matter. So what I'm saying is, for example, Domino's. Domino's didn't give a bottom about their customers, and then their earnings started to decline severely, and they needed a whole leadership change. And this is happening to AutoZone. Their revenue growth is slowing down, and customer reviews are horrible. And I've seen many people saying that in their hometowns, AutoZones are closing. Of course, this is purely opinionated. This is not based necessarily on statistics, but statistics are also sometimes useful in tandem with anecdotal evidence. So if you have anecdotal evidence that the business isn't doing well, this may be a pre-warning sign. And I think that AutoZone's hyper valuation combined with very problematic customer reviews combined with a slowing growth rate, this is just this just isn't a recipe for success. Of course, at the right price, everything is a bargain, but they just aren't at the right price. If the stock price was, for example, $2,000, then yeah, I think they would be a buyer, or not necessarily 2,000, but 1,700, $1,800, that would be a great price. But 2,000, sorry, 3,800, this is just too much for me. If you want to invest in them, please go ahead. But for a value investor, this is just too much. This really doesn't make any sense because there are much better opportunities out there. At the current price, they're basically more overpriced than Nvidia. So yeah, this is absurd for a automotive parts company. Uh, Before I end the video, I'd like to talk a bit about our affiliate ticker data. Ticker data is the tool that is in this video, so you can see here with this template, and if I put in a ticker symbol, all of this gets updated in real time. And also I can choose the fiscal year, so this is a great tool. Also, do not forget to check out my investing blog from the link in the description below, where I recently posted an article on the European stock market, and I'll always post monthly articles on very interesting topics, and all my articles are very in-depth. And for you savvy investors out there, I think you'll just love it. I hope to see you in the next video. Bye.